Hi everyone, my name is Piterpakulski. Today we have a final overview of a mobile application financial model. So I will walk you through the inputs that you will likely need to start this business. I will be telling you what useful features does financial has to obtain to make you be able to play with scenarios easily, to make you be able to see different versions of your project, of your business idea. So if you find this video valuable, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So let's start, guys. So first of all, we have a unique rule through all the financial models. So all our inputs are colored with blue. So if we want to adjust some inputs, we are just searching for these blue cells and put the data in. So that's why if you send this model to your business partner, to the banker, whoever, so this person will be able to create able to easily create different scenarios to play with inputs, so all inputs are easily can be found. So this is very important because the scenario that you are showing may not be scenario that your business partner is interested to see. So he might want to play with data, and you have to provide him opportunity to play with the data. And by coloring the inputs, you will simplify this process, and this makes your project be more, the probability of a good conversation of your project is growing, because you simplify the way everybody can work with your financial model. So the first input, we are setting up the first year of our financial projections. Then one of the most important inputs is when your project gets the first revenue. So you just set up month and year, and what is valuable, so you can displace your project to the left and to the right inside the timeline, and all the inputs, all investment plans, all revenues will be displacing automatically. You won't have to retype the investment plan expenses each time you or your business partner will be creating new scenarios. And you simplify the process of creating scenarios, and that's very important for the future steps when your project will be discussed with bankers, with your business partners. So even for yourself, it will be very easy for you to play with huge amount of data. So then we start speaking about the investment stage. On the investment stage, we have two types of expenses. Because it is a startup, you will have the huge amount of expenses will go to payroll. You will need to pay developers. So here you can specify the positions of these people, salary monthly, and also you have a coefficient to play with the salaries during the investment stage and look at the simple and discounted payback period, what will happen with the project if you increase or decrease these expenses. And also you can look at financials, main financials, total financing needed, cash balance at the end of the project, simple, discounted payback period, net income, net present value, profitability index, internal rate of return, if you increase or decrease these expenses. So you won't need to play with this data. You can just increase or decrease this coefficient. So 100% is just a basic value. It means that you are using basic values of these numbers, and you can easily increase and decrease payroll on the investment stage or using only this coefficient. So this makes also the play with scenarios very fast. Then we are moving to amount of people that you will need during the investment stage. So this is the moment of release when you get the first revenues, and this is the amount of people that you need before you get the first revenues. So these are their salaries, and these are the amount of people that you will need during the investment stage. Then we are moving to the vendor expenses on the investment stage. So here maybe you will also have some outsource expenses, and let's call it vendors, and here are the names of vendors that you can specify, and here you are able to put the numbers of expenses before you get the first revenues. Also, you can switch on and off different expenses of the investment stage for this or that vendor, so you can include or exclude these expenses from calculations, and look at the simple and discounted payback period of your business idea. So this is also very important during the scenario play. Also, you can adjust these expenses without completely switching on and off of them. So you can use just this local coefficient for this or that vendor expense for this or that vendor, or you can use the coefficient for these expenses for all vendors. So this is the general coefficient, this is specific coefficient for each vendor, and this is if you want to completely switch off this expense, you can just switch off, and that's it. Then we are moving to operating stage expenses. So when you have the revenues, we have also people in different positions. Also we have some web designers and different other positions. So here is the monthly salary of one person on each position. We can also switch on and off this or that position to see the performance of business idea, to see the cash flow of this business idea with or without this or that kind of person. Here is the coefficient to the salary, and here is the general coefficient for all the salaries. So you can also play with these coefficients instead of playing with these basic numbers. So this is also very valuable when you are done with the project, when you are done with the initial inputs, and you start playing not with these data, but you are starting playing with coefficients to see that if for example salaries increase by 20%, the simple payback period will grow up to, for example, 70 months, and you will see that how stable your business idea is. So this will be very valuable for you. Specify the amount of people on each during activities. We specify on the left, here on the left we have the names of
positions, and here we specify the amount of people on each position during the timeline.
And see the November change here from November to other month. All the data of the revenues on all the expenses of operating stage, investment stage will be displayed automatically, and you will avoid different types of mistakes that people usually make when they display these or that revenue, these or that expense. They forget to display the expenses, so this is very important. So then we are moving to vendor expenses during the operating stage. Also we have the names for these for these vendors that we have during the operating stage. This is the amount that we spend dollar per month. We can switch them on and off, and we can use a local coefficient for these expenses and also global coefficient for these expenses. Without playing with these numbers, we can be just playing with these numbers. So this will also show how stable your business idea is. Then we have a coefficient for amount of application downloads and percentage of active users of our application. So we will need these coefficients for revenue generating algorithm. So let's move forward. So let's move forward. So here from November 2022, as we set up earlier, here we have the amount of application downloads. Here we specify the amount of downloads. Then we specify what is the percentage of active users from those people who downloaded the application. And this parameter can also be dynamic during the operating activity stage. So all these parameters, amount of application downloads, is a dynamic parameters. So you can specify this data. Then we specify what will be the paid traffic. So how many of these amount of application downloads will be paid. So at first, when your project will be green, you will be just entering the market. Let's say 100% of downloads you will get from paid traffic. And as your project will grow, the amount of paid downloads from paid traffic will go down, because people will be more informed about your application. So you can also specify this parameter in dynamic during the operating activity stage that we specified higher. So next, then we are moving to, so we have the horizon of 10 years, and during these 10 years horizon we can monthly specify all these inputs. Then we are moving to another very important part of financial model, about different types of users of your mobile application. So you can create a portrait. So in this block of inputs, you are creating the portraits of your users. You can name them, create the names for them. You can switch them on and off from calculations. For example, if you create some optimistic portrait from perspective of revenues, you can switch this portrait of user off and see what will be the performance of your business idea here from perspective of net present value, simple, discounted payback period. You can look at the diagrams, what will happen if you switch on and off this or that type of user. Then you specify the duration, the interval for the payment of premium membership. So some of the users will pay you monthly premium membership payment. Some of them will be paying you once in 2 months, once in 3 months, once in 6 months. Some of them, for example, once in a year, and some of them will be using your application for free. So they won't be paying you anything. And here you can specify the periods of payments of premium membership. Then we are moving forward to the next very important chronological parameter is life cycle of this or that type of user. So the interesting thing is that all your customers, all your users won't stay with you forever, and you have to create limits for the revenues of this or that user. And these limits you can specify here. So for example, you can say that this type of user will stay with you for 12 months, this group will stay with you for 12 months then disappear, then this will stay with you 24 months, this will stay with you for 3 years, and this will create more accurate revenue algorithm, and your revenues will be lower, but they will be more close to reality, because if you won't create this algorithm, you will get a higher unrealistic revenues, unrealistic profits, unrealistic payback period, unrealistic financing for your business idea needed. So everything starts, this mistake starts here. So first of all, you need to create some portraits from perspective of life cycle, and this will move you to the right way. So then we specify the life cycle. So for example, 2% of customers will have these parameters, 3% of users will have these parameters, and then he will allocate 100% of all the users, specifying allocating percentages inside these type of users. So we, for example, assuming that 21% of users will be paying us once a year. These users will stay with us for 3 years and then disappear, for example. Then we can also, for example, here we specify the amount of payment during the we will be able to set up the amount of payment for this interval. So they will be paying, for example, $4 once in a month during 12 months. This user will be paying once in 6 months, will be paying $24, for example, and he will be paying us during 12 months interval. And the amount of these users will be 5%. So we can here specify the payment. Also, we can add a coefficient for this payment to see what will happen if membership payment will grow or decrease. So this is very interesting also for you to see what will happen with the business if your membership payments will be less or bigger than the basic value that you were bearing in mind. So this is also very important. As you can see, I already played with these scenarios because the base values of these values, the basic values in this column will be 100%. The same is here. So then we have coefficient also for membership payments. So we have local coefficients, and also we have global coefficients for all membership payments if we want to increase or decrease the values of all membership payments, not depending on specific type of customer, but we will be just increasing the membership payment for all types of customers. So it can help you with scenario building because you can easily add this coefficient. For example, specify here 110% and see what will be the simple discounted payback period if the revenues from membership will grow on 10%. So then we are moving to direct costs. Then we specify different so the next block of inputs is devoted to direct expenses per user. So first of all, we calculate the amount of users that we have in this or that moment inside the timeline of our business idea, and then we specify what direct expense per amount per customer do we have. Then we specify, so here are the names of items, direct cost items per user. Here we specify the amount of cost per user per month, and then we will get the direct expenses that are linked to the amount of users at this or that moment in timeline of our project. Then we specify the marketing and advertising expenses. So here we specify different types of sources of customers. Then we specify how much we pay for this or that new customer user from this or that source, and then we specify, we allocate the 100% between the sources from which we get our new customers. So let's say, for example, we get 40% customers from users from YouTube, and for each new customer, new user, we pay $10. So this is the initial payment. Then we move to, then we can specify the loan, the amount of loan, if we take any, the term of loan, interest rate, grace period for principal payments, for grace period for interest payments. Then we specify when we get this loan. Then we specify the values of the rates of taxes for our project. And here we get the cash flow. So all information that we've specified is now put in revenues, direct expenses, fixed costs, payroll, taxes. Here we can see how our project breathes itself. So what are the revenues when project reaches the break-even point without loan payment? What is the moment when the project gets the first profit? We can also look at how low payments affect our operating activity. We can also see here how much money we need from ourselves or from investor or for our business partner. So we need, for example, if we take this amount of loan, we will also need this amount of money from our pocket. So we can look at cash balance at the end of the period and see when we get here a zero, and zero means that at this moment, the project starts generating its own cash, and we don't need to finance our business idea from the bank loan, from investor, business partner. So this is the moment when the business starts living on its own. Then we see here the table consolidating the amount of financing from different sources, and gives us the total of financing needed for the business idea. Then we can specify the discount rate for our business idea and the step of changing the discount rate to get the more accurate internal rate of return. And then all this data comes here. So these are the final values of financial efficiency. And here we can create some stress testing scenarios. For example, we can add this coefficient to, let's say, we can go. So we can go here, for example, and add this coefficient to of stress testing to amount of application downloads. And now we can push the sense button and see what will be the financial efficiency if the amount of downloads will be higher, will increase or decrease. What will be the financial efficiency in this case? So let's press it, and I will show you how it works. So now we can see the what will be the financials if we increase or decrease the amount of application downloads. So if we increase this amount, the financial efficiency will be better. If we decrease this percentage, the financial efficiency will look bad. And what is valuable in this case? For example, we can just, these are the basic values that we have. They are coming from here, and these are scenarios. What will happen if the amount of downloads of application will grow 20%, 40%, 60, 80. We can also adjust the step of change of parameter here. And for example, what we can do, we can, for example, go back to the inputs. We can take away coefficient from here, and now we can add this coefficient to another parameter, whatever we want. So for example, we want to add this parameter to membership payments. So we can add this coefficient to specific type of user, or we can just add this coefficient to all users. So we can add this coefficient here, add the multiplier, press enter. Then we can go back and press send button again and see what will happen with our financial efficiency if the membership payments, premium membership payments, will rise on 10%, 20, 30, 40%, or decrease on 10, 20, 30, and 40%. So let's press. So this is the end of our overview. I decided to show you the final version of this model because it is very important for you not only just to build this model, but you have to be able to easily play with different scenarios, where you have to be able to play with inputs easily, to displace the data from left to right in the timeline, and you won't have to retype a huge amount of data, because while retyping you will be making mistakes. So I hope you enjoyed this video. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.